All right. Thank you very much, everyone. Thank you for joining us today at the Mortgage Innovation Committee. I'm your humble host, Joe Darlene. I'm the SVP Head of Strategy for First Close. And today I'm very excited to present to you this awesome webinar we put together. We've been working on it for quite some time too as well. So we have some really engaging and excellent content for you today that we'll talk about. But first, before we get into that, just a word from our sponsor. Dustin, can you take that over, please?
So let's thank our sponsors at Incelerate. So Incelerate helps lenders close more loans through better borrower engagement. And it's the industry's most innovative customer experience platform, which delivers lead management, sales enablement, and engagement, robust mortgage-specific content library, and data intelligence in an all-in-one comprehensive and highly scalable platform. Incelerate delivers dynamic technology, strategy, and content for every channel of your business to ensure engagement throughout the customer journey, whether that be with your borrowers, referral partners, or any other partner to the loan transaction. The dynamic enterprise solution seamlessly fits into your existing tech stack, whether that's phone integration, POS, LOS, servicing, data enrichment, due to their advanced API connectivity, modern design, and open architecture. So gone are the days of managing multiple and separate systems like your CRM, marketing, automation, lead management, and having your data trapped in silos. The innovative platform allows you to provide your internal and external customers timely, relevant information based on data intelligence to build repeatable outcomes at each stage of the customer journey. So as we always say on our podcast, if you're not following Josh Friend on LinkedIn, you're missing out. He's got a lot of great content there. He puts out, I think, Joe, he's got something out there every day or every other day. He's on a webinar. Or he's providing some great content. So you're missing out if you're not following him on LinkedIn there.
Yeah, he just did a great one with Michael Hammond the other day too, and Michael does a lot of work for him, and Michael works with me as well. So I've known Michael for years, and Michael and I also share a passion. We're also on the Progress and Lending group too as well, board members. But okay, great. Well, thank you for that. So I think today, really, this is an important topic, I think, in today's marketplace. So this alternative lending, when people think of it, what does it really mean about that? And what does it really mean about alternative lending in today's marketplace, and how, in its own definition and its application of this type of strategy, how can it play into your origination strategy going forward? Stats tell us, the MBA is telling us 2022 will see about 74% of all mortgage origination will be purchase money. So how does this affect the purchase money? This is a very important topic in today's euphoric real estate market we're seeing today. And so next slide, please. I just want to introduce my guest today. We have Eric Morgenson. He's here from Angel Oak. Thank you very much, Eric. Always great to have your passion here and everything else. John Lynch, he's going to talk to you about the direct-to-consumer. You mostly do this on direct-to-consumer space, right, John?
Yes.
Yep, John's with us today. And Darius Santos, thanks for joining us today too as well, Darius. I'll get a chance to introduce you all here in a second. But to open it up, Eric, let's just kick it off to you first. Give me a little answer to this question we're seeing on the screen right now.
When you say alternative lending, you guys, there is an underserved market out there, and these low rate agency loans, it has even widened the gap how underserved it is. And that is the borrower with some impaired credit. That is the borrower that is self-employed. There's about depending on what survey you're looking at, there's about 45 million self-employed Americans out there taking advantage of our 70,000 page tax code. And now it's time to qualify for a mortgage. And what do they have to do? They have to amend their taxes to show enough income to qualify for a loan. That's awful painful. So these are the underserved borrowers out there that have been underserved since the financial meltdown that we focus on here, the alternative mortgage programs for them.
Yeah, that's awesome. And I think most of us know about what Angel Oak is all about too as well. John, talk to us about PCMA and what you're doing with your private client lending. And what does this sentence mean to you today?
Yeah, so we're in the alternative space as well. I think the term alternative kind of has a connotation of, like a subcategory. We operate in what I would consider the super prime space. Mm-hmm. We deal with, exclusively with the high net worth and high capacity households. The majority of high net worth households come from some form of either asset rich retirees who have accumulated wealth through investment, or the majority of them are business owners that have built, mid to large scale enterprises and have accumulated their wealth that way. And so, there's a grossly underserved market in that community because the depositories are no longer supporting that community in the manner that they used to pre-credit crisis, and the liquidity that's been available to them has been anemic to almost nothing available to them for well over a decade. So we've spent the last couple of years just reintroducing that community back into the market and letting them know that liquidity is here to serve their needs.
All right, Darius, give us a little answer to this question up here, and what does it mean to you today?
Well, I think that as John and Eric kind of mentioned here, there's a large underserved market, that the market is red hot right now, and we have an ability to serve this market with some innovative processes and technologies. That's probably it.
Okay, good. Talk to me, Eric, again about this purchase money angle. As I witnessed and kind of told you up front, Eric, you have control of the deck and you can move it to any piece that you want to next. But talk to us about the purchase money space and why that's so important. Yeah, there you go.
The purchase money space. All right. What everybody knows, this unprecedented refinance boom is gonna cool off eventually. Then we're going to go back into the traditional lending, and that is primarily purchase money. And you have such a red hot market out there. Number one, the economy went like this over the last 4 years. So you have a lot of people that literally, old Jed's a millionaire again, self-employed, that made a ton of money, again, taking advantage of all the write-offs. And number two, we have a supply and demand issue out there when it comes to housing. We don't have enough housing to keep up with the demand. So that's going to drive housing prices up further. A lot of people think that we might be in a bubble right now. Supply and demand is actually keeping that at bay. So 3 core programs at Angel Oak is the debt service ratio coverage. We call it the investment cash flow. You have an unprecedented market right now that investment properties are being gobbled up at a rate that none of us that have been in the industry for a long time, I'm obviously the oldest guy on this call, has ever seen before in the history of lending.
I challenge that.
In the history of lending, this has never happened before. So hard money, as everybody might know, left the owner-occupied space on January 10th, 2014, when the CFPB delineated what is a qualified and a non-qualified mortgage. So they're only in the non-owner occupied space, where debt service coverage is literally a rate that's half of what hard money lenders have. And if anybody hasn't done a debt ratio coverage loan, what we call an ICF, they're the easiest loan you can possibly do because there's no income. You leave the employment blank on the 1003, blank. How easy is that? I could even underwrite one. All you really need to do is read an appraisal, read title, and there you go. So right there, that helps a lot of people buy those properties that wouldn't qualify. Why? Maybe they maxed out at 10 properties with Fannie or Freddie. Obviously, they're writing everything off on their taxes, or maybe they don't document the income, that rental income on their rentals already. So right there, those purchases are red hot. And obviously the owner occupied purchase with the alternative programs, or somebody that literally might have had forbearance, and a lot of traditional lenders are kind of giving them the Heisman Trophy stiff arm in not entertaining that. What we do is non-agency. Me and John both agree to this. When you call it non-QM, it's really not fair calling it non-QM. It's really non-agency, because we can do a loan for somebody really fresh out of a Chapter 13 bankruptcy where Fannie and Freddie don't, but you're not charging over 3 points origination. That makes it just a normal loan. It doesn't make it a non-qualified loan. So don't get hooked up on the non-QM stuff. This is simply non-agency. We love the borrower that doesn't fit in agency guidelines, that makes sense. I think that's the difference.
Yeah, that's cool. That's cool. John, did you want to chime in on that topic?
Yeah, and I can layer on, because Angel Oak and I we cross over a lot of markets, but we also serve different communities. You know, our minimum loan amount's $1 million. And so we tend to operate in the high net worth and ultra high net worth. And so the term non-QM it's a compliance term, but from a marketing and how we refer to it, could you imagine calling a guy worth $50 million? He's a non-qualified mortgage applicant. Like, you want to talk about pissing somebody off, you know? So, you know, it's a term that I think as a community, we should all refer to. It's just non-agency. You know, before that, we didn't use terms as compliance. We had Alt-A, we had Prime, we had different things like that. We didn't use compliance terms. So from the standpoint of that, you know, Eric said it, you know, as well as could be said as far as, you know, the repositioning of debt. A lot of the ultra high net worth and high net worth are taking cash out of their homes as an offset of what they would call basis in the properties that are exposed to the impending inflation and an erosion of their basis. So they're now taking property they're taking excess basis out of their properties and reinvesting them in other properties, like in their investment portfolio, as a hedge against inflation and CPI in the coming years.
Got it. Excellent. Excellent. All right. Darius, did you want to jump in on this, or should we go to the next slide?
I was just going to say that we do have, considering this audience is growing, we're going to cover some details here. What this means to other panelists, I mean, other attendees of this, is we're going to be talking about ways to reach these people, ways to get in front of these non-QM, non-agency individuals. So that's going to be a focus here of my part.
Go ahead, Eric.
Okay, so here's the path. When originating one of these loans, how do you help them qualify? It's just simply understanding these programs, you guys. On a bank statement, it's really simple. You're self-employed, great. Let me ask you a question. Do you document a lot of income to the IRS on your tax returns? There's a great question right there. And you're going to get, well, not really. Okay, great. Well, we have an alternative for you. If you can go full doc, by all means, go full doc. You're always going to get a better interest rate going full doc than you do bank statement. Bank statement's always going to get a better interest rate on a non-owner occupied than going a no doc or a debt service coverage. It's just a cascading effect right there. It's really not that complicated.
Right. Okay. Go ahead. Next bullet.
I'm going to bullet all these.
Okay, great.
Okay. Debt service coverage. You guys, again, the easiest loan out there in America is a debt service coverage loan. It's not hard. We normally you see lenders will go to 80% loan to value, but a lot of times it doesn't debt service coverage, especially out here in California, where, geez, I can buy a $1.5 million condo in Newport Beach. The payment to Angel Oak is going to be, let's say, $4,500, but I can only really rent it out for $3,500. And that's at an 80% loan to value. I'm not even 1-to-1. So we got to lower it down. At Angel Oak, we will allow at 85 or at 75% LTV. If the borrower has a 700 or higher credit score, we don't care if debt service covers. We will allow a negative debt service coverage. Why? Out here in California, everybody loves the appreciation slope, not so much as the cash flow. But in the Midwest and in the Lone Star State of Texas, I can take that $1.5 million, go buy 3 properties, each at $500,000 a piece, and literally get $2,700 a month rent. And now I'm more than positive cash flow. So it's a different strategy. Mm-hmm. The borrowers with a credit profile. Listen, we're just trying to do common sense loans, that the stuff that Fannie and Freddie are not doing, but it is a good borrower, and their circumstance does totally make sense to do a loan for them. That this is what we're going to do. All the stuff that Fannie and Freddie are and us taxpayers are all subsidizing, we like to do that. Like on our program, if it's a full doc, we only go off the primary wage earner's credit score. We don't care about the co-borrower's credit score. See, little nuances like that is what we're helping. And a life in credit events. What that is a bankruptcy is now a credit event. A foreclosure is a housing event. Hard money now becomes private money. So we have all these kind of softer terms, but listen, good things happen to bad people. That's okay. What you'll see that John, with this high net worth borrowers, these self-employed people are risk takers, and boy, they swing at that plate, and every now and then they're gonna miss. So maybe they let an investment property go into foreclosure because the tenant trashed it, or maybe they have 3 companies and in one of their companies had a partner that was a shyster and they let that go into bankruptcy. But here they're really doing well. Well, let's just look at that borrower from a holistic standpoint. We want to see the entire picture, and does this loan make sense to do a loan for somebody that has a recent issue with their credit? If it makes sense, we're going to fund the loan. John?
No, I agree with all of that. I mean, there's, one of the things that we do, with high capacity borrowers, if we look at from a credit perspective, we don't necessarily look at it from your traditional matrix point of view. We look at it from a capacity point of view. The average age of our borrower is 60 years old. They've been a homeowner for 3 or 4 decades. They are not only the credit behind their personal life, they're the credit behind their professional life. They've been managing credit their entire career and their entire, credit life. And so a lot of times they've amassed enough liquidity and wealth where we'll bypass all of the underwriting scenarios and we'll use an asset depletion or dissipation scenario based off of last month's Merrill Lynch investment statement that had 50 million bucks in it. And we suffice our ability to repay right there because we could literally liquidate the account today or a portion of it and pay the debt. We move right to collateral and rep and warrant underwriting. So, different. I think the point that Eric is trying to make is that, the agency business is moving to an algorithmic model. It's not there yet. It's still a blend of human and digital, but it will go digital. It will be point and click here in a matter of years. They're just trying to do it in the most diplomatic way. They will run AVMs off of their database. Everything's just going to be an algorithm of credit probabilities, and non-agency, where we're going to underwrite outside of ones and zeros, is going to be the future of what I would consider, let the platforms that are going ones and zeros and the rockets and all that dominate that space. And then the professionals that are on these calls today, if we want to maintain the longevity of our careers, we have to bring something to the table. They're going to bring speed and technology. We need to bring intelligence and IP.
And expertise.
Correct.
And I think, John,
you need to move away from being a generalist in the space, because your value in that space is diminishing every day because it's going to be taken over by the platforms. You need to move into a specialist position and understand all of these things. It's not difficult to understand this stuff. It's just new.
Yeah, but you have a particular, John, you have a particular experience in what you're doing today, because the way that you underwrite your files, all you really are up against is just that one forensic review, and that's it. Once that's done, you're drawing docs and closing.
Not every file. I mean, our average loan amounts of somewhere between 1.5 and 2 million. So we still get that, small business owner guy that, we do bank payment calculations. But then when you get the ultra high net worth guy, we can avoid some of the brain damage in that. And the only reason I bring it up to the panel is that they might have a rich cousin or a rich uncle or somebody in their family that, is going through the Morgan Stanley process and the brain damage that they have to go through. And now they can go to a streamlined mechanism. And now through high net worth realtors who have high net worth clients that want to go out and buy more investment properties, different things like that, you tie into programs like this, all of a sudden it only takes one client and you could have a banner year.
Yeah, that's true. But in the world of non-agency, we kind of have, like you said, this agency, fulfillment, basically day one certainty, appraisal, rep and warrant, boom, 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 draw your docs, fund your loan, service it the way you need to service it. In the Angel Oak model, as an originator, maybe even an IMB, I could still work with Angel Oak and I can send in these type of files. I don't need to worry about docs. I don't need to worry about the calculation of the bank statements. They handle that. But in your area, in your particular expertise and non-PL lending, basically, there's not a lot of people that have your type of experience.
I didn't get here by accident, right? You just start moving one foot in front of the other, and you make it. The difference is you're never going to be good at anything if you don't identify a market you're going to serve. And I can tell you, if you stay as a generalist in the market, in the agency space, the platforms that are spending, hundreds of millions of dollars in technology and marketing are going to continue to erode what you bring to the table for the client. If the client can go online and go click, 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 and it's done, then there's no need to have a represent.
No, it's a valid point. It is a valid.
So moving into the space where they need information and because there's a lot of variables and moving parts. It reminds me of 1996. Everybody had a guy because there was a lot of moving parts, and you needed somebody to situationally underwrite my circumstance and then go find me the best solution.
Right. It's true. So I was there as well during those years.
We're all doing ourselves.
Yeah. But I think it goes to say that in today's environment, even when you're dealing with your agency products that you can knock down because he's buying a couple non-owners, you may run into the situation where you need that non-agency. You may need that DSR loan because you can't get all the qualifications together, right? And where you may have to bring the dad and son are buying a property together. We have a friend of mine who he's on his 12th loan already between him and his dad, and they've just been buying property like crazy. And now he's getting to the point where now he has to do the DSR loans, or now he has to do the non-agency type loan. But assets are not the problem, right? Like you said.
Right.
Okay. So this is a really important conversation in today's environment, because as what we're trying to educate everybody on, you need to kind of wean yourself off of this refinance euphoric model that you've been living in for a little bit, and then specialize into areas where you think that you can help your local market succeed with this type of lending. It's nothing to be scared about. It's on a big trajectory on the way back. Some of the stats that Angel Oak has produced over the last couple meetings and everything else, it's just been amazing. Some of the stats that are happening. You better keep your eye on this area of the marketplace. So okay, let's go on to the next topic then, Eric, and then we can. I want to make sure we save some time for questions, but okay, here we go. Why don't you tell us about this?
Okay, so you guys, you can see back here in 2003 to about 2007. Look at the market right here. This right here made sense. These were when, if it was a self-employed borrower, we'd go to about 80% loan to value. We wouldn't have to review their tax returns, but we're documenting that they have the chops to repay the loan. Then we get into the wackadoodle doodle days right here, where a train wreck for credit, history of never making a payment, 100% finance, and state whatever you want on a 1003 for income. That was absolutely, that was nuts. Then we come into, this was common sense, this made sense, but look at, this market hasn't even come close to catching up. For all you originators out there watching this right now, literally, as John and as Joe were saying, I'm not saying stop doing your refis. No, not at all. But what you want to do is learn about these programs. It's not rocket scientists. You don't need to be, these are simple loans. Just don't be throwing these borrowers back in the pond. Start funding these loans, because unless you've made enough money to retire in this refinance boom, in a few years from now, if you still want to make money, this is the lane. It's Fannie, Freddie, FHA, VA, hard money, and non-agency. That's what we got. John is a very specialized, I call him a loan snob, because he only deals with high net worth. Like if the loan's not $1 million, he's like, oh, well, throw that back in. But I'm here to tell you originators, you can truly get rich on the niche. Any loan officer in America can do an FHA, a VA.
Tweet it out, rich on the niche. You gotta tweet that one.
Everybody knows. Everybody knows as a loan officer, you can do all those. But your referral partners, your community, your sphere of influence, they might not know that you have access to these alternative lending programs.
Right.
And when you become when you become good at these guys, you're going to make a lot of money. As you can see by John Lynch, bank statement loans are normally extremely big loan amounts. Why? You don't see a lot of W-2 wage earners out there buying a $2, $3, $4, $5, $6 million house. 100% of the time, folks, they're self-employed. And all you folks out there, you're paid on basis points, right? We're here to get you great at these loans because they're extremely profitable. So look at the potential out there. Less than 15% of all licensed NMLS loan officers in America, as I'm telling you this right now, has done a non-agency loan, has done a non-QM loan. Look at, you have a huge head start right now. John, anything you want to add to this?
No, I mean, I have, you outline the opportunity from an alternative lending perspective. I then in coming slides will outline it from, a delayed financing opportunity that's huge in the market.
Yep, good. Roll the slide because we got to get Darius in here too. He's got some stuff in the back, I think.
Well, should you care about non-agency? Literally to serve your borrowers, to expand your product reach, to expand your customer base, and to make a lot of money for yourselves.
Or expand your sphere of influence too as well. Yeah.
Indeed, indeed.
Yeah.
Okay. Again, everybody can do a non-agent, can do a Fannie or Freddie loan. Everybody knows it. Everybody knows every loan officer can do that, but not everybody is doing these loans. Specialize in it. Obviously, it's going to increase the size of your bank account.
Yep, that's for sure.
All right, so let's say my I'm making it rain because I've got a good sphere of influence. I've been in a community for a long time, and I have all of these realtors that, sure enough, Eric, you're going to get the loan done. You're going to make me look at, and I'm going to get my commission when I sell that house. Great. Now, if I go, oh, you got a self-employed bar, oh, I really don't do those. Great. That realtor is going to go find somebody that does bank statement loans. And boy, if they find somebody like John, like Darius, or like Joe, who is on it, they're also going to grab all of their other business as well.
Take that market share right from you.
That's right. So, and it's happening right now daily. Listen, you're in a symbiotic relationship with your realtors. If they don't get paid, if you don't get paid, they don't get paid. If they don't get paid, you don't get paid. So why not stretch your reach of loan programs that you're able to do? Obviously, the earnings. And here's the thing, every loan that you do for every borrower, you have to ask for a referral. If that is not an atomic habit in your head to ask for a referral, even maybe the loan didn't go great, still ask for the referral. Always ask. If you're not, it's crazy. Now, John, Darius, who do self-employed people hang out with?
Other self-employed people.
Isn't that funny? Isn't that funny that we tend to hang out with people just like ourselves? If you're not asking for referrals, oh my gosh, you're limiting the income for yourself. That's a pet peeve of mine. John, anything you want to add here?
Yeah, I think that was perfectly said.
Okay, so I'm gonna keep these all up. So as Joe had mentioned, the delayed financing out there is an unsung hero. Look at, with this market so heated up, we have this little bit of a perfect storm going on where, holy moly, I want to win that property over. I've got to buy it. So what do? I come up and old Eric's going to stroke a check and I'm going to beat everybody up. Well, geez, I'm now out hundreds of thousands of dollars. Didn't anticipate it, but I needed to do that to get that property. Now what am I going to do? I'd love to have that money back and literally go buy some more property. Well, the delayed financing, you can literally get all that money back. And with Angel Oak, to us, that is, we treat it like a purchase. So it's rate and term. It's not a cash out if it's a delayed financing. Really simple to do. John, you doing a lot of these?
Yeah. Well, I mean, not only are we doing a lot of them in the current marketplace, but you have, hundreds of billions of dollars of loans that have already occurred. nationwide, that you know, at the end of the day, these people have, there's especially for my client book that understands, you know, when you take after-tax dollars and you put 100% of a basis into a property that's appreciating whether you wanted to or not, but you have CPI eroding the basis against the property appreciation, it is imperative as part of their financial plan to put leverage on that property to minimize the exposure to their cash basis that they have in their home. So coming in and pulling 60 or 70% of that basis back and redeploying it into other assets to hedge against the erosion of the US dollar, that they've made investments into assets that are already using it as a hedge.
Sure. Sure.
Darius?
We're good. I think we're covered.
Okay, good. Right here, the self-employed bank statement loan is the Mac Daddy of all non-agency out there, folks. It truly is. Look at the size of the market.
1 in 3 borrowers are self-employed.
Look at the size of the market. This is, listen, you got Freedom, you got you got these huge companies out there that focus solely on VA. That's it. That's all they really want to do is VA. This is 4 times the size of the market. All right, adverse credit. This is going to be coming back, you guys. Post-pandemic, it softened a little bit. Capital markets are not really keen on impaired credit borrowers. However, it is slowly but surely coming back. We're at Angel Oak, we're doing the stuff that Fannie, Freddie, FHA, and VA, well, not VA, but FHA, Fannie, and Freddie will not do. We will cater to this borrower.
Okay.
So next slide, please. And we all know it. Here's the funny thing about the mortgage industry. It's always cycles. For all you newbies, it will always do it. It always has. It's always going to cycle, and it's always going to change. Just keeps doing it, and yet we know it, but a lot of us don't prepare for it. We know it's coming, but we keep doing what we're doing every day. So this is like a brief story of this guy's in the desert, and he's about to die of thirst. He's been walking 100 miles, and he comes up to a well, and next to the well is a glass of water. And it says, at the well, it says, use this water to prime the well in order to get water. But this guy's so desperate that he thinks, wow, if I don't drink this glass of water, I'm gonna die. Do I take the risk and do I prime the well with this glass of water, or do I just drink the water? Well, what he ends up doing is he takes it and he primes the well. Sure enough, it works, and now he's got all the water he needs to sustain. But some of you are going to go, wow, I'm just going to drink the water, and now that's it. That's the analogy that a lot of you folks are going to take this information and go, wow, this is great. I'm honestly going to dive in to these non-agency loans and get better at them, and watch that well's going to keep pumping for you. But a lot of you are going to watch this and then go back to your normal course of business every day. Which one of you? Are you priming your well, or are you drinking the water out of the glass, and that's it? We all know this is coming.
That's a good way of showing it.
So as you can see, the projected increase is, you guys, it's all in the numbers. We continue to do this hockey sticking with these non-agency loans. They're not going away. This is now mainstream. Why? Never in the history of America have you had an ATR compliant loan, meaning that we could document the ability to repay, for a rich person who is making $2 million a year, but on his taxes, he's reflecting, because he has these legitimate write-offs, $64,000 a year, but yet he's able to turn around and buy a $3.5 million house. Never before has this happened. Guess what? Number one vocation out of bank statement loans at Angel Oak are real estate agents. Fastly becoming number 2 are CPAs. Folks out there, can you imagine having a small army of certified public accountants taking their self-employed clients and telling them to go to Joe for their loan? You think they're going to call Joe and start grinding him on rate like an agency? No. And can you imagine, because I'm self-employed, of course, I'm never going to do my own taxes. My CPA knows where all my financial bodies are buried. And he's telling me that I go to Joe in order to buy that house, which is extremely emotional, let's say, to me and my wife. Folks, this is what we're talking about, a huge opportunity to make a lot of money on these loans and take care of your client base.
Wow.
Anybody want to add anything to that?
Well, I would say, you know, the what I call the you know, specialist professionals, right? You know, they don't just, we get more wealth managers, CPAs, trust attorneys. We get more referrals from them than we do realtors. Because in today's market, the consumer that is in that space understands that I'm never going to have my real estate agent isn't going to refer me a loan. I'm not even going to enter the market. It used to be it always hubbed off the realtor, but in today's market, they know they have financing issues. They solve the financing issue first, then they engage a realtor, and it usually becomes from their CPA saying, hey, or their wealth advisor saying, hey, you have too much basis exposure. You need to go buy things. And then they go engage a lender like PCMA or Angel Oak, get hard approval, then engage a real estate agent. And then the real estate agent goes, wow, you got that loan. Then you're like, I need that loan. And then that's how that usually begins, right? And then a lot of times if the real estate agent is calling you saying, I have a referral for you, it's because their loan at Chase blew up.
That's
and
right.
I've got 5 days before I've got to release contingencies. Can you help me? And, you know, sure, we'll do our best to help you there. But the best way to build a resource book that you can really provide a client experience and a depth of knowledge in a space where there's, if you want to go get high net worth clients or self-employed clients, go to the professionals who have a big book of that business that get asked all the time, how can I assist my book? It allows them to extend the practice or their services of their practice and provide more value to their client.
That's excellent. It's really good.
So I'll rip through this real quick. And what I wanted to talk about is pre-credit crisis. Between 2003, 2007, on average, we did $2.8 trillion in annualized loan volume. Post-credit crisis, ATR, QM, Appendix Q, all that, 2013 to 17, the most we can do in the lowest interest rate environment in history is 1.7 trillion. So I looked at that market and say, where did $1 trillion go? And we come to the conclusion that it's in this borrower profile that was once in the market and is no longer. And I just want to show you the delayed financing opportunities. You know, I did a quick data study just in California with an average loan amount with the purchase price between $750,000 and $5 million. I didn't want to get into the $25 million Beverly Hills houses, and I didn't want to get into the Blackstone buying all the single family stuff. I wanted to get into the space where your business owners buying primary residence properties. So primary and second home on the date range of January 2010 to this was August of 2019. The home had sold all cash and had yet to retrieve any or recapture any of their basis, any of the money that they put in to purchase the home. The average purchase price was 1.482, right? So that's upper middle class. In California, that's a starter home. But you know, the amount of transactions that occurred between that window of time was over 80,000 transactions for $120 billion. When you want to figure out, like, where did the $1 trillion go? Well, people used to use leverage pre-credit crisis to buy homes. And then now everything, if you ever watched a $1 Million Listing Home, everything on their show is all cash, closing 5 days. Not, you know, if that's what you're competing against, look at the borrowers that we serve are active, but there's no trust in the market. The sellers selling homes do not trust mortgage financing. And if you think it's going to slow down anytime soon, there's my chart right there.
Yeah.
The chart is saying it. You know, pre-credit crisis, we not only went into escrow with mortgage contingencies. Shit, we went into escrow. I had to sell my house and get a mortgage, and we did that all day long. Today, it's like, you're buying my house cash, and the opportunity is to get that liquidity back in the market by going after the borrowers and helping them recapture on a delayed financing. Now, a lot of the brokers might not know what delayed financing means, Eric. What that means is it's not a cash out loan. You just delayed the purchase. So you get purchase pricing favorability and underwriting because you're not building excess leverage into the property. You're actually taking what you would have originally taken. But so the opportunity is work with realtors who are doing all cash transactions. Let them know that I will not be involved in the transaction so that you can get best bid. Close in cash, but I will build synthetically and inside a side saddle, I will build with the loan. So when you open escrow, I open escrow. When you pull title, I pull title. And then when you settle all cash, and we'll close a week later, and they can pull back 70 or 80% of their purchase price and put it back into their wealth management account and pay off the loan that they used to bridge.
Beautiful.
Yeah, so they're buying it all cash and they delay the financing up to 6 months, folks. And that's a rate and term that is not a cash out. So they get a purchase rate, but they're not financing it for up to 6 months.
Sure.
Really popular, especially in the market as it is today. It's going to change, but right now it is cash on the table. That's how I'm going to win that house.
Right. You get a lot of folks that are kind of tied up today thinking they want to chase this new kind of bridge type loan or new kind of the real estate agent's going to buy my old home type thing, when you could do the financing this way and control the whole transaction.
Yeah, and it takes the stress out of it.
We also take out hard money lenders. Hard money lenders can, close in 2 days, and they used hard money, and we come right along and take out the hard money loan.
Sure. Makes sense.
Yeah, and to be honest with you, hard money lenders are great referral partners because their loans come to term, and they're short-term financiers. They don't have long-term financing.
Yeah, no, I know. I was at the Pitbull conference. That's what they were all talking about. They just want to do these short-term deals and get in and out, and then
have the referral for the client. If he hasn't already set up his long-term financing with someone else, let me refer you over to this person.
Yeah, hard money lenders hate the investor.
Time check, you guys. I got to keep you guys all on track. We got to get Darius in here.
All right, Darius.
All right.
On,
so just asking for referrals, you guys, it's really not that tough. You just have this atomic habit of always asking for referrals, letting your sphere of influence know that you have access to these programs. That's not tough. That's that easy.
All right, Darius, what you got, brother?
I was going to say, this is actually exactly where my contribution comes in is, so we talked a lot about this market and how to serve it potentially. So the first piece you guys have is to do the research, become the expert. And then the second piece is to let everyone know. And the opportunity here is to differentiate yourself from the other lenders that are in your referrals, right? Because everyone knows a guy, right? Everyone has 5 guys, realtors, mortgage, but this is your opportunity to let people know you can serve this underserved market. And the way to do this is a couple, right? My expertise here is going to say use the power of video, because you guys is a trust-based business and people are overwhelmed with the emails and direct messages and things. We don't have a lot of time and our attention spans are short, and that goes for everyone else. So what we need to do is let people know in a very engaging, effective way. We're all in a trust-based business, and if we're sending out text messages that are paragraphs, that's probably going to get not even heard. So the power of video, particularly YouTube, LinkedIn, video messaging, like directly video emails, getting your personality, your expertise in front of your audience, in front of your sphere of influence, is that opportunity to make bigger noise, right? You can get more of your emails heard, more of your message understood. They remember your face. It's just a much more powerful way of staying top of mind. So as we said, the very first part of this is do the research, become the expert, but then you can't sit in your closet and with your book, you got to let every single person in your sphere know that you have these programs available, that you are this expert. You can share things like, close your first non-agency deal and then share that story, right, with your whole audience and say, hey guys, I had a guy who couldn't get traditional financing, and I wanted to share a story with you about how we were able to overcome some of his limitations. And now that video is going to hit home to a lot of people that are going through that same issue. And so that's why I encourage the use of video here for this opportunity for differentiating yourself, because not a lot of people are doing it. It's still it's just like we're an underserved market. It's an underserved technology, and our business is so trust-based that it only makes sense to get in front of our clients if we're not doing it in person. You know, phone's great, but it's also not scalable. You're sitting there on the phone or in a Zoom with someone on a one-to-one basis to try to build that trust, and using pre-recorded videos, like I said, YouTube, post to social, and directly sending videos is going to be the way to scale that trust building opportunity without, you know, spending hours on the phone. So
yeah,
that's pretty much these next couple slides is about leveraging the power of technology to get your new lessons and your new expertise out there. So study up, then make some noise.
Yeah, that makes a lot of sense. What's the next slide there, Eric?
Darius, real quick, nails it. If you're sending a video to a potential borrower and the rest of the loan officers out there in America, from Loan Depot to whatever big box, are emailing your borrower, but yet here's a video of you explaining to them the process, the program, they can actually see, listen, your personality comes through on these videos, believe it or not. Be yourself, watch, you'll be different and you'll pick up more business. It works. It does. It works. So there's a boatload of marketing out there for all you that are watching this right now. We can go offline, reach out to me. I'll dial you into all the marketing. Listen, marketing only works if you use it.
Consistency. So this little slide here is just a little preview for you guys of what it actually looks like when we're sharing a video, like through a direct message, through their LinkedIn, through a text message, through email. Any way you can communicate with your clients, you can communicate with video through that same channel. And it also provides a lot more intelligence. So actually go ahead and click a couple times. There's a couple little bullets here. If you could for me, there you go. Communicate with more people. As I mentioned, the scalability of video, you can send one video to your whole list of past clients, of realtors, or whoever your sphere is. You can get that one personal message in front of all of them in a much more effective way than email. And you can see even in the body, it shows up as a video itself. So they instantly know that they see your face, your expertise, you as a personality. So the other thing, like just some things here, face, tonality, all those things that happen, like we mentioned, personality, and people retain information better when they watch it in video versus any other form besides maybe interpersonal communication. So they're going to understand your message. They're going to remember it better, going to stay top of mind better. So when that non-agency person comes into that circle, they're going to know, oh yeah, John is the guy, man. Let's get it over to John. So, and of course, then finally, there's the communicating more intelligently, because when you send an email, the best you can get is, did the email get opened? That's the very best you get, maybe with some technology. When communicating with video technology, you can actually see who's watching the video, what percentage did they actually make it through, did they engage with that video, did they share it? Those types of things are the analytics and the information you can get from communicating with video versus other forms of text. So.
Yeah, good buying signals from when you have the data, for sure.
Right, exactly.
And I use this, you guys, and I can't tell you how truly simple it is to operate. All you do is you click a button and you talk into your camera, set it up, and email it out. It is just the easiest thing, but you do have to like wake up and possibly take a shower. You can't be like in your pajamas. But honestly, you've got to be like you're dressed for the office when you're in front of your computer all day long.
At least this far up, your shoulder, your weight up,
At least that. I mean, these guys are trusting you with a big deal, right? That you don't want to be dressed like a bum when we're trying to build trust. So
unless you have your golf shorts on and you know you're going to play golf.
It's all right. They'll connect to that. John's clients will. I was going to say, Eric, how many videos have you created, man? It's thousands, right?
I have, you guys, and I'm not the fastest typer, so honestly, it's a shortcut for me. Instead of typing out a big long dissertation, needing that the most current bank statement on a bank statement loan, whatever, I can just rip it in a video and off it goes. And then I get a response, whoa, that was cool. What is that?
Right.
Because they saw the video. Nice. Okay. All right, what we're doing here is choosing a non-agency lender. You want to make sure when you're doing that, you guys, you want to make sure that they're really not a mortgage company. They're not in the non-QM space, but they're in the service business. Because at the end of the day, you guys, what we do is we serve our clients. If you're not aligning with somebody that's truly obsessed with being in the service business, it's going to be a long day for you trying to do it. It will. If they focus on non-QM, now there's a lot of great companies out there that have FHA, VA, they do all sorts, even commercial lending. Oh, and over here they offer some non-QM product. If it's really not their space, they're underwriters that are underwriting agency all day, then they get a non-QM loan and it's kind of wonky. It's kind of a little bit of a disconnect. You want to find somebody that truly focuses and specializes in it. Looking at if you just get into this non-agency business, folks, I'm here to tell you that you're gonna make some mistakes. Angel, look, we've been at this going on 8 years doing bank statement, 8 years. So in the early years, I'm gonna tell you, it was messy. It was kind of wonky. It wasn't smooth. Boy, we got this down to a science right now. So you want to find a partner that's been at this for a good long track record. And the rest are pretty self-explanatory as far as, how do I put this? You just pick one that matches your personality, your way of doing business. At Angel Oak, we will let you know if you're a non-agency loan, if it qualifies right up front. If it doesn't, we're going to let you know right away. What drives me crazy, and I know it drives everybody crazy, is working on a loan for 4 days, maybe even a week, only for it to get killed in underwriting. Nobody has time for that madness. We let you know right up front if you got a loan or you don't through our pre-qual process. So that's about it for that. With that said, Q&A, Joe?
Yeah, so we have some questions that have come in here. We only got a few minutes left, but that was great input there at the end, Darius. I really appreciate it, and I purposely wasn't trying to hold you off this whole meeting, the whole entire time. But I think that where can the folks today, where can they go and get some really good advice quickly on some of the programs, availabilities? Do you guys have webinars that you run? Do you have training sessions? Do you have those type of things that they can grab some resources from?
Absolutely. With us, we have a national presence, and invariably we have an account executive in your area. Just reach out to Angel Oak and we will have an account executive visit you in person or via Zoom, whatever you're comfortable with, and walk you through the entire process. Again, it's not tough.
Okay, because I mean, I think there's some angst around, hey, how do I really look at these bank statements? You don't want to look at them. You just gather them and give them to your lender, let them tell you the income, and then you qualify your borrower. Is that the best way of going about it?
Well, what we do is we are not good, but we're great at decoding wealthy, sophisticated, or any self-employed Americans' income out there via either their business or their personal bank statements. That's right. You just fully bake a 1003, complete a 1003, give us the credit report, and give us the bank statements. Go off to find more borrowers while we decode and calculate what that income is for you.
Yeah, don't try to do it yourself. You're not going to know about what's in and what's out on the bank statements and everything else, unless you get to John's level, where you can just look at them very quickly and have a great understanding. But that will take time. So it's not a mystery. It's nothing that you really can control. Yes, your borrower told you on the 1003 that they make $32,000 a month, but the bank statements say only $17,000. But guess what? $17,000 works. So who cares how much you make? So yes, don't agonize over these bank statements. You'll probably agonize just to get them together, right? To deliver them. Okay.
I got a quick question.
Okay.
How do you originate a bank statement loan? What do? What kind of questions to ask? Listen, these self-employed borrowers are extremely controlling personalities. John, I can only imagine the characters that you work with day in and day out. These guys have grown, and these guys and gals have grown very successful companies. A lot of times, not 1, 2, but they have 10 companies. And you're going to get them on the phone and you're going to be kind of intimidated by these folks. We will show you how to originate these loans and take all that angst out of your world and watch. Again, you're paid on basis points. We're going to get you great at these.
All right. All right. Okay, great. That's awesome. Good feedback. Thanks a lot, John, for your time today. You probably this whole hour, you probably missed out on a huge amount of income. So I really appreciate you giving back to us in the industry. And I know the only one that's making money on this whole thing today is Darius, because everybody saw what Darius was doing. Now they're all calling Darius.
Right.
So remember now, come back and join us at the Mortgage Innovation Committee. We do these on a monthly basis. It's because of you and what you've done and what you've given back to our industry that makes this a really good session. I'm sorry I couldn't go through a lot of your other questions that you had today, but we gave you all the contact information for everybody. Please reach out, and thank you very much for your time today. I believe this is one of the most important sessions we've done all year, and I'm really looking forward to success in the coming months ahead for each and every one of you that attended. Thank you very much, and make it a great day.
Hey, thanks to Josh and Accelerate.
Thanks, guys.
Yeah, for sure. Josh, Rand, Accelerate. Awesome.
Nice.
Good shout out.